David, I've been trying to get you to sit in front of the cameras for a while because you and I have had a few conversations in the past, and I always walk away educated and intrigued by some of the stuff that you talk about because you have a really unique way of looking at things. Just quickly run us through a little bit of your background, and then let's get into it because there's so much to talk about right now. It's crazy.
Yeah, quickly going through my background is I'm not sure that's possible. So as you say, I'm with Fortress now. I'm the Chief Investment Officer of the Convex Strategies group. But I'm just doing what I've been trying to do for 28 years out here in Asia. I arrived in Singapore way back the first Monday of October 1987 to be told how lucky I was to come to Asia to be a trader. I was then with Bank of America. And how easy it was, right? You own the assets, you own the currencies, you rode the yield curves, you earn the carry. And then 2 weeks later, those guys lost their jobs in the October 87 crash. And that was sort of the first time it dawned on me that, I had just arrived. I was a brand new, coming straight out of the training program. I didn't think I knew anything. And it turned out the guys who thought they knew everything didn't know anything. And I've been sort of trying to figure that out ever since. So, I've worked throughout Asia. My claim to fame was being a part of and building the emerging markets business for Bankers Trust out here through the 90s and through the Asian crisis. Gave me the unique opportunity, fantastic place, pre-Basel I, pre-Glass-Steagall going away, a place that understood our job was risk, not revenues, right? We were an investment bank. We didn't have a deposit base. We didn't have then the implicit guarantee. We had to intelligently intermediate risk, which gave us the chance to innovate many of the markets and products that we trade today. And really that originated from this concept. One, emerging markets were different. Using historical volatility and correlation didn't measure risk in a world where currencies were pegged or closed markets or central banks did this or governments did that. And obviously if those things changed, volatility and correlation would change significantly. And then the concept that we weren't investors, we were risk managers, traders, if you will. But if we wanted to do that, you couldn't risk manage a market until you could short it. Right. And so really our job, and the way I've always seen what I do, is I trade, you will, or now more like invest in liabilities. Most people think of trading or investing in assets, but assets are risk, liabilities are hedges. They're negatively convex, these are positively convex. And so most of the products that we invented, NDFs in the FX market, or interest rate swaps, or cross-currency swaps, or equity swaps, or whatever, are in essence liabilities that allowed us to then manage risk around the asset markets in these complex environments. And so I did that from the sell side for a very, very long time for Bankers Trust. And as it turned out, that philosophy, which led to some pressure in the business because we weren't maybe making as much money as guys who were levering risk, turned out to be incredibly successful when in 97, 98, everything went the other way, and owning convexity was the key to success. And we were the owners of all liquidity in the market. It made us quite profitable and important to our clients, because really I was in a client business, right? Yeah. And then the same thing again, I joined ABN AMRO and went through the same process with their business through 07, 08, the merger with RBS. And so it gave me a front row seat at the sort of poster child of systemic crisis risk, one of the worst run organizations I've ever had the distaste to be a part of. And then left to move to the buy side and joined some friends of yours at Artradis, who had been very successful in managing a hedging, positively convex risk strategy. And then so successful that they eventually moved on to other activities. And we've come here to Fortress to try to help provide people hedging solutions, risk solutions.
It's interesting you talk there about helping people, because what you do with managing volatility strategies is the kind of help that everybody needs and nobody seems to want right now, which is fascinating to me, so close to '08 when nobody had it and everybody needed it all of a sudden. What's happened to that mindset that was sheer panic in '08 and now people are like, well, I don't need insurance.
Well, as you know, and we've discussed, one of the big problems, and in fact, problem I think institutionally as a whole, is what I call the agency bias, or the other people's money strategies, which was so prevalent in the banks on the sell side, which really the major contributor to the '08 crisis. The guys with the fiduciary responsibility don't share the downside, and they've managed to construct an institutional given that they get rewarded for picking up the pennies and dimes, and the guy who owns the money gets crushed when the bulldozer comes along.
Right.
And so that's a real major challenge to overcome. And something, again, as I said, in my old banking days, I used to be under significant pressure within the business because I wasn't making money levering up subprime CDOs, and other people were. Now, subsequently, I made a whole bunch more money, but that didn't actually fit within the sales side business. And without going into much detail, I was told bluntly by senior people, yeah, but we get paid when we make money on this, and we get zero when this happens. So even if you make less during the good times and then make a whole bunch when something bad happens, you're still getting paid zero because I've put the bank out of business.
Right.
And so this is what management wants us to do. We work for them, not for shareholders. Right? And so that maybe isn't as extreme in the money manager world, but there's still that problem where I talk a lot about, in terms of what we do, that your fiduciary manager and yourself are out on the tightrope picking up pennies and nickels, but he's got a rope tied to him.
Right.
Wouldn't you, as an investor, like to have a safety net below just in case? Also, to encourage you to go out and pick up more pennies and nickels, because the central banks and their policies are encouraging you to do so. But if you're scared of it, you're actually not taking advantage of it. But you're the one risking the fall, not your fiduciary manager.
Well, even if you pick up 10 pennies and put one of every 10 you pick up into some kind of insurance policy, you would think it makes sense.
Yeah.
But you talk about central banks are encouraging you to do that. They're also, at the same time, they're saying, hey, go out and do that. They're also saying, and we'll make sure that if you fall, we'll quickly string a net up for you. Don't worry, you won't fall far. And that's incredibly dangerous.
Well, they've always done so. I mean, the cycle, as we've come to learn it, the now extreme, exaggerated financial cycle, which is sort of taken over from the traditional trade and business cycle, really is driven by that. I mean, moral hazard, right? I don't know if you. So I gave a presentation once, back in September of '09. The guy before me was from the BIS, talking about how Basel III will eliminate any systemic risk ever in the future.
Right.
And then my presentation, at the request of other policymakers, was the cause of the crisis was Basel BIS regulatory guidelines and the moral hazard that went along with it. You let guys significantly mismeasure risk in a moral hazard supported funding strategy, paid them for the upside and socialized the downside. And that still goes on, and people still are using VAR, or value at risk, or as a measure of risk, which, despite the fact that we all know it's wrong, Basel III is still based on risk-weighted assets, despite the fact that we know it's wrong. And at a subsequent conference, the same guy and I were on a panel, and he didn't like me very much anymore. And he said, the key to Basel III success is harmonization. We've got to make sure everybody follows it. I said, so you're saying that the problem last time was banks' balance sheets weren't enough alike?
Right. Yeah, but this problem of correlation is a big one. You deal in trying to mitigate that, and yet everything is starting to get this correlation of one.
Yeah.
Precisely because of the actions of these guys putting things in place that are inherently deflationary. We'll talk about inflation, deflation in a minute, but when you bring in things like FATCA and you bring in all this legislation and regulation, this is stopping an enormous amount of expansion in the financial industry, which obviously bleeds into Main Street.
Yeah.
So these guys are shooting themselves in the foot every time they get the gun out to try and scare someone in.
I mean, it's funny because we all know from simple portfolio theory that diversification is arguably the key risk mitigation strategy. And yet you've got regulators all trying to force everyone to do the same. It's amazing, right? And so what you know, from a business perspective, you know, and you know, my cynical side is virtually all regulation is trade protectionism, right? It's to protect the established participants, right? And so the U.S. with FATCA being an extreme is the U.S. trying to regulate globally, but even EMIR is trying to regulate globally, and Dodd-Frank is trying to regulate globally, and Basel III is trying to regulate globally, and it's all in the end trade protectionism, and it reduces diversification of business activity, squelches startup businesses and competitive and new innovations and et cetera, which inherently makes the system more risky,
right? Because
everything is concentrated in fewer and fewer hands, and the same mistake gets made by everybody instead of having a capitalist system where a whole bunch of little mistakes get made by a lot of people, and sort of through survival of the fittest, the strong come up and bad ideas get weeded away. When bad ideas get written into the global regulation of banks, then it becomes systemic risk.
But that's largely because it's all about political theatre nowadays. It's not really about solving the problems, because if this was about solving the problems, we'd have a completely different landscape. None of the problems have been solved. And you talk about that, and you look at what's going on in Greece now, and you look at how this whole thing is playing out along political lines. It's nothing to do with what's best for the creditors or the Greeks. And I think the Latvian Prime Minister stood up in the Parliament hearing yesterday and said, look, do we want to save the EU, the creditors, or the Greeks? We can't save them all. And that's the reality of it. But as you and I have spoken about off camera, this is being driven by, the answer is Europe, now what's the question? And so if you manage anything to an end and ignore the fact that there should be winners and losers, as you've pointed out, how does that have a good outcome? I just don't see it.
Yeah, it doesn't, right? Because it just gets worse. One of my favorite sayings back in the Asian crisis years was, one thing we've learned is if you lend somebody more money than they can pay back, is they won't pay it back.
It's one of the simpler laws.
And we can use accounting tricks, and we can call it a performing loan because we lent them more money to pay us back again, which is Europe's strategy. But the problem never gets resolved until that loss that is now trapped in the mythology of accounting treatment actually gets recognized and assigned to where it belongs. It looks more and more like those losses are going to the taxpayers.
Yep.
The losses which should have been on the banks got bailed out. As I said to you before, the borrower never gets bailed out. It's the previous lender who gets bailed out. The borrower can't lose money. Only the lenders can lose money. Yep. So you transferred the losses of the big European banks and their Greek debt holdings onto the Greek taxpayers, who clearly don't have the financial means to resolve those responsibilities. So subsequently to the European taxpayers in mass, or Germany more specifically. And so until you solve that, the problem will go on and on. And the Greek situation, they can take the next austerity package and the bailout to pay off their debt, because none of that money stays in Greece. Sure. And at the end of that period, they'll still have more debt than they can pay, and so you keep going and going. So I used to draw a picture, this goes back to the Asian crisis and then again in the European crisis, of people, mountain climbers going up a slippery, snowy mountain, and then when guys start to fall, the big guy at the top, the central bank, puts a rope down, and then as many people as possible jump on that rope, and then if that rope gets too heavy for them and starts dragging them down, then the IMF throws them a rope, and if that gets too heavy, you'll see time and again, particularly the Asian crisis was a great example. The solution to this was to eventually cut the ropes, right? And accept the bankruptcies and assign the losses, because if the rope gets too heavy, who ties the rope to the IMF? Well, I guess the U.S. and the Fed, but when Russia cut off all foreigners, all of a sudden the issue was over, right? Yeah. They could stand on the mountain on their own again. So I feel that very much the same way about Europe, that until you resolve the debt, if you want to keep the euro, which everybody knew was a flawed strategy, so they made rules around it about debt to GDP and fiscal, right, to try to protect the flaws, and now they let everyone break those rules. So if you want to keep the euro, you have to reimpose the rules and reset the debt one way or another through forgiveness, through currency rebalancing within a new EMU type system, and keep going. But that means the losses have to, that logically there's a great big hole over here and all the dirt is piled up over here. Logically, you'd use that dirt to fill back up the hole, but we'll see. But to just keep dragging it on and on and on, right? Think back to how big was Greece's debt?
Right.
5 years ago,
Yeah.
It was tiny.
Yeah.
Now it's 350 billion euro.
You made a great point, and you spoke about this before we started filming, that whole idea of the Asian crisis being the model. I mean, people say, well, we don't know how this works out, and your point was perfect.
Yeah, I argue this regularly because I was in Japan for the bubble bursting. I was in Asia. We've only really seen one of these ever get resolved successfully, and that was Asia. And that's because the deleveraging took place. Right. That's because bankruptcies took place. The IMF came in and imposed, rules that people were forced to follow. In fact, in Korea, they still refer to it as the IMF crisis, right? Because that's what caused, the pain, right? And you had really sharp contractions in growth, 25% unemployment, and then long, gradual, sustained recoveries as the cleansing took place. Now, the challenge with that solution, and that was imposed by the U.S. and IMF and was successful, but why don't they use it again? Right. Well, the problem was it also changed every government, right? Governments that had been in place since the war in Indonesia and Thailand and Philippines and Korea and Taiwan and Japan, and all got moved out because this was a painful process. And I suspect the guys, running Brussels or the guys running, nobody has the political will to do it now. And so we keep going with this scam and with this sort of inflationary transfer of wealth, right? And we all know that ends badly. We all know historically that as that segregation gets too far, that rubber band stretches too far, it snaps back even harder. And yet, the machinery that drives it thinks that this is the solution, and even guys that were advocates of the IMF programs in Asia that in hindsight were very successful are now advocates of, the reason this hasn't worked in Japan or hasn't worked in Europe is because we haven't done enough of it. We have to do more, which is laughable.
But in the Asian crisis itself, we were here in Asia when it happened, and it was painful, right? I mean, you could see the pain all around. To anyone that wasn't here, it's the Asian crisis, the same way as it's October '87 or it's the Great Recession. It's just a little fancy title for something that happened a world away. But we saw that take place. We saw all the brush get cleared, and Asia eventually and painfully emerged. But it proves that that's what happens. This is a natural cleansing process. And yet the powers that be in the US and in Europe, I think their debts have got so big that the thought of the pain they would have to go through is terrifying, and nobody wants to be the guy who imposes it. And if you think about that, nobody wants to make a proactive move in case something bad happens and they get the Paul Volcker Most Hated Man in America Time magazine cover. So does that mean that for however long this thing plays out, the world is just hostage to some kind of cobbled together response to the next bad event?
Yes. I think, and we're seeing it already. I compare I think of the world as, and it's again one of the differences between maybe me and how the financial system is structured. What matters is the endogenous risk, and yet the whole world revolves around exogenous shocks, right? Everybody, is measuring the risk of the next fire by the probability of a lightning strike, when what the actual risk of the fire is how much dry grass there is on the ground. Yeah. And what we call black swan events, right, is where there was a really low probability of lightning strike, and then the fire started because kids were playing with matches. Well, nobody could have seen that coming, right? When the whole time the risk was the amount of grass. I always, joke, I have a bunch of friends in the insurance industry. I say, in the financial industry, you would insure a cargo vessel based on the probability of a storm. as opposed to the value of the goods on the vessel, right?
Right.
And so we've constructed these things like value at risk and et cetera to allow this mentality to go on. And so, the way I see the world and the way since my 87 crash, it's all just this cycle, this sort of tug of war back and forth, between inflation and deflation pressures coming from the two sides of the global balance sheet, or imbalance sheet, I like to say, right? Everything to me is zero sum. And for every asset, there's a liability, and for every revenue, there's an expense. For every surplus, there's a deficit. And so sort of the world, this big global imbalance, is one side of the world has too much debt. I call it the deficit of capital side of the world, the West, the developed world. The other side is the surplus of capital, the East, or EM, right? The sort of the ultimate flaw being they're tied together through the reserve currency. And so both sides use the same monetary policy. So you've got a monetary policies that's set by the guy who's got this massive debt overhang, debt deleveraging, deflationary pressure constantly, trying to fuel that, feeding through the reserve currency that these guys are all tied to, fueling the side whose risk is inflation, right? And so you go back and forth and you have these deflationary shocks, 87, right? Or you have an inflationary shock where it goes too far, 97, 98 coming from this side, then a deflate, think back to '08, right? This battle that was going on. So in '07, this side starts slashing rates, right? Because the debt overhang is pressuring them. And so you start getting inflation like crazy over here. So in the first half of '08, everybody over here was hiking rates, 100%, right? Which eventually slowed it down enough that you push the pressure back on this side and this collapse comes. So, it's just this sort of tug of war back and forth as we go through the various cycles. I always kind of think of this side chasing this side ahead in the cycle, right? And so I go back to my forest fire analogy, right? The cycle, in essence, is liquidity, right? And so you have a long wet season as liquidity builds and grass grows and it's all nice and green. And that sort of liquidity pendulum eventually peaks and then starts back the other way. Summer starts and you start to get a contraction. The Fed hikes rates or other central bank hikes rates, and private sector credit starts to slow and the grass starts to dry. And then you start getting more wildfires, right? You get I grew up in Salt Lake City, Utah, so fire season's a big part, right? Everyone knows what that is. And you get a fire over here, and then they run over and put water on it, right? And it goes out, and then it starts to get drier and hotter. And you get a fire over here, lightning strike, or kids playing with matches, or a backfire of a motorbike or something. And and then one day, because there's been so much grass, you get the fire here, and they wheel out the truck, and the wind changes direction, and the whole thing burns down, and you get that crescendo. Now, the beauty in financial markets that we live in, because of the way risk is measured and managed, is the cost of fire insurance is inversely related to the fire risk, right? Because the risk is greatest in the part of the forest that had the most water during the wet season and has gone the longest without a fire, which we measure using things like VAR as the least amount of risk. All right? And then you have the wonderful thing that the place that's just had the biggest fire and there's nothing left to burn, the insurance is the most expensive and the risk is the least. And so in essence, that's the job of a investment manager, is to, sell insurance where the risk is low because it's already burnt, and buy insurance where the risk is high, where there hasn't been a lightning strike for 10 years.
But then you run into the agency bias because it's a hard thing to do.
Yeah.
Your analogy is a good one about the pressures from both sides, particularly in light of the fact that side suffering the deflationary pressure is now out of bullets. They can't cut rates anymore. The Fed's quintupled its balance sheet. So what do you do the next time that shock comes down?
Yeah.
How do you deal with that?
Yeah, it's interesting. So in my analogy of the forest fire and sort of these guys chasing these guys around the cycle, right? In essence, we've already gone through inflationary shocks in many parts of this surplus side, right? Sort of taper tantrum 13. Right? You went through the, what did they call them? Fragile 5, right? Well, that's exactly what that was, right? You guys they had unsustainable credit growth start to deteriorate their current account deficits, which is, again, to me, just inflation, right? Your demand's grown beyond your productive capacity, so you're having to suck in somebody else's productive capacity. You'd be hard pressed to convince Russians that they haven't already had a crisis, right? Or Brazilians or Venezuelans or, even more so the North Africa and Middle East, right, where what people call the Arab Spring was actually onion prices going up, right? Something that Bill Dudley and I talked about years before that. But so, now we're in this interesting thing where these guys have moved so far ahead in the cycle that they're now actually coming down the other side. So China, who had the most extraordinary credit expansion, which is what I would call inflation, right, is trying to manage the fact that that was unsustainable, and every time they let credit growth just moderate, the whole thing starts to get sucked down the tube. So now you've got the major economies haven't even started to come out of their cycles back up yet. These guys have already inflated and are now deflating. Singapore property prices down for however many consecutive quarters, just as these guys are trying to raise rates. And you've got this crazy environment where interest rates are at zero. I go through this over and over again.
And have been for 6 years.
They're at zero. I mean, and it's pretty universally accepted, even amongst those in charge, that rates were too low for too long when they were at 1.5 for 15 months. We've been at zero for 6 years, and asset values, which again they don't consider inflation by their measure, but are obviously inflation. Asset values are at peaks. Employment is at peaks. Any way you measure it, they're way, way, way behind, and they're always behind. You've mentioned this before; they're always behind. But you've never seen something like now, where the Fed and the Bank of England. I keep putting in my monthly letters, pictures of Fed funds and London, or the bank rate and London property prices. Yeah. Right? And it's extraordinary, and so I think this liftoff, or whatever you want to call it, is incredibly complicated. Rates should have normalized years ago, and they haven't. And so the process of this normalization, I was telling you, I said at a conference just a couple months ago that I believe the Fed will eventually hike rates, but not because it has worked, because it hasn't worked, because the risks are greater than the benefits. Yeah. And that's going to be really complicated. The financial stability risks in their terminology are outweighing the benefits to their reputed dual mandate.
But then it becomes what they've created for themselves, which is a communication problem. Right. How do you communicate that and stop people thinking, wow, this is... Because the narrative has been, it'll be a 25, 50 basis point hike and it'll all be calm. As soon as people get it in their heads that it's the start of a tightening cycle, which several people have commented on, there are entire trading desks who've never seen a rate hike, never mind a tightening cycle, and so wouldn't know what to do with it. As soon as people think, you know what, it's not just going to be 25 basis points, we're on the way back to even 1.5%. It sounds ridiculous saying it, instead of the long-term average, which is way north of that. As soon as people think, then the Fed's lost it, because they can't communicate effectively to stop people acting as if rates are going back to somewhere normal. Yeah. And they've built that prism for themselves.
I'm on an advisory board on a thing with a bunch of policymakers, and a gentleman has just joined the board. So the policy guys are usually ex-monetary committee members, right? The guy who's just joined had the unique distinction of serving his entire term without a policy change.
Okay, great.
Right. We never changed rates the whole time, and yet never met their bogus inflation target on one side or the other. So. Yeah, it's. I think it's going to be, uniquely disruptive, right? The misallocation of resources, the malinvestment in Austrian terminology at this extended period of subsidizing those who extraordinary low interest rates benefit at the expense of all others, will be an unwind of epic proportion. I mean, just the simple concept of valuing things when your discount rate is zero.
Yeah.
It's worth infinite, and then at 25 basis points, it's worth zero.
Right.
And so the impact of that is going to be so extraordinary. I mean, I go back to going into the crisis in 2008, and when I was running sell-side businesses with very large, diverse derivative activities and et cetera, I had a discussion with some policymakers about the implications of once we crossed October 1st and 3-month LIBOR, which is the the benchmark of benchmarks for valuing every discount curve, moves over the year end, and with the dislocation in LIBOR, which now in hindsight turned out to be manipulation to some extent, but didn't get resolved, then liquidity would disappear because you wouldn't be able to value anything. And more than anything else, the disruption in the derivative markets, I credit to that. It wasn't Lehman going under. Markets still functioned, and then one day we switched to, that was middle of September. One day we switched to October, and all of a sudden nothing functioned. And that's because money markets were trading here, but LIBOR was fixing here, and you couldn't discount anything. You couldn't discount any future price, whether it was an option or a swap or a CDS or a equity, right? You couldn't discount, so no one could agree on a price, and so liquidity disappeared. And so to some extent, that challenge is going to be the same but different when we try to move from unprecedented low discount rates to more normal ones. And the impact to the changes in valuations will be a shock to the system. And from my business perspective, a very simplistic change in volatility. I mean, volatility is simply liquidity, right? It's just a liability. Right? And so when you fundamentally change the ability of valuing something, well, volatility inevitably is going to go up.
Well, but this is real world thinking and real world problems, right? Valuing assets, valuing companies, valuing businesses, and yet the people making these decisions don't look at the world that way at all, and they're quite open about that. That's not how they think. So these things work for a while, and then when they don't, very bad things happen. Right? And the longer you leave it, the worse the problem gets. You spoke about 87 when your introduction was, here our kid, here's a seat. Oh, by the way, we all just got fired because of the crash. Yeah. You came out of that period of incredible disruption, which lasted a very short period of time, having learned a very, very valuable lesson. And I look at what happened in 08, and you're going to see an entire generation of guys who were your age, the age you were in 87, have come out of an even bigger dislocation, having either learned nothing or worse still, having learned really bad lessons. How does that resolve itself? Because you've now got an entire generation of people that don't understand the way this stuff is supposed to work.
Yeah, and compounded with my agency bias.
Right.
They have no downside. And so that incentive again to create short-term returns using these flawed risk models just grows and grows and grows. And the guys who are good at it get promoted and become the bosses and incentivize people to do more. And so the risk builds up inevitably. The grass grows in my fire analogy, and the next cycle is more painful than the last, and that one was more painful than the one before it, and more painful than the one before it. And I said at that 09 conference when I spoke after the Basel guy, and he had said, Basel III will ensure the mistakes that led to the systemic risk last time won't happen again. And I finished my speech saying, well, not to disagree with my esteemed co-speaker, but I'll argue that the systemic crisis that, let's say, was kicked off when Lehman was allowed to go under, because the allowing of Lehman to go under raised doubts in the market's mind about the will of the governments to support this financial system. And I suspect the next round, some years and years and years down the road, will be when something happens that raises the question of the ability of the governments to support this system.
It's a confidence game.
And so, Greece is a great example of, holy moly, maybe they can't fix it.
Yes.
It's not just that they don't have the will to do it, maybe they actually don't have the ability to do it.
Well, and yet, if you think back to the beginning of the Greek crisis, you think back to 2012, you think how funky markets got because of the slight prospect that what's happening right now might happen. You think of the dislocations we saw. The European project was about to go to the wall until Draghi stepped up. Here we are with it actually happening, and the volatility of the event has been dampened incredibly by what's gone on before that. And suppressed volatility, as many people say, always leads to hypervolatility. So what do you, is there anything, if you're trying to rank the potential risks out there, where do you see the most danger of something coming undone?
Well, again, I'm more about the endogeneity.
No, sure.
And any of these shocks, Greece or China or whatever, I think China is extraordinarily risky because it has arguably more grass than anywhere else, right?
Yeah.
It's grown the most. Its credit expanded the most. I mean, the growth of the credit, official and unofficial, the shadow banking, wealth management product, it's tripled, quadrupled since the crisis, unprecedented scale. And nobody's ever managed to do that before without a hard landing. In fact,
Agreed.
I've heard a lot in my career about the mythical soft landing. I've never seen one.
No,
never ever seen one.
Goldilocks hasn't shown up yet either.
So, but the core of it all, again, in my sort of big liquidity pendulum, is the Fed. Right? The Fed, the reserve currency, that the printing of that and the multiplication effect that has as it spreads throughout the whole system, despite the fact that Janet's bathtub is only a U.S.-based bathtub, doesn't account for the fact that you can move capital over here, right? So I really think, the driver to the summer season, the fire season, is the Fed, and I do believe, like I said, I believe the Fed will lift off because they're doing more harm than good with these policies. I'll be shocked if they can ever do QE again, given that. It's not just in the Wall Street Journal, it's in every popular newspaper out there that QE is just redistributes wealth. It just makes the rich richer and the poor poorer.
But to the public, is it not preferable to hear we're going to do QE? Because they'll find a way to justify it.
Yeah, they say it creates a job, right?
Right.
It creates a job.
And if the alternative is mass unemployment, huge pain.
It's funny. The same people who don't believe in trickle down taxes believe strongly in trickle down asset inflation, right?
Yeah.
So, they can go on and on for a long time, and Professor Yellen was my macro professor, as you know, back in my Berkeley grad school days, and even back then, she's very much of that, neo-Keynesian mindset that. And she's a wonderful lady. She reminds me of my mother, right? That if she can fix a problem, she should fix it.
Right.
And I say, but you're not. All you're doing is transferring. Anytime you move money from here to there, you're likely creating a problem here. And she would always say, well, if that turns out to be a problem, then I'll fix that one. Right. And so, they very well may keep going and keep putting more water on the grass, but that water on the grass is just combustible material for some future problem. And the big risk, and this is sort of where I fear they're getting themselves, right? Water is in fact your best tool for putting out the fire. But then you say, and also it'll help grow the forest back. Right. And you keep using it and using it and using it to grow the forest. You may not have enough water to put the fire out next time. Right? And you'll find if you prevent every little fire that comes up, eventually all of Yellowstone Park will burn to the ground, and you don't have anywhere near enough hoses to stop it. And so that's always the risk, right? That you let this endogenous risk build so large, so complex, that the remaining water in your reservoir isn't going to work.
But that's clearly the path we're on. That's clearly the path we're on. But is there any stopping it now? Because it feels to me like there's no stopping that. Once you've gone down that path as far as we have, there are periods and points in this process where you could have said enough.
We'll take some pain here. We'll take some pain here.
But it doesn't feel you can't. I feel we're past where you could take a little pain, and so I just don't see how they can stop this. As we've said, they are traditionally behind the curve, and they've always been behind the curve. It just so happens that now they are so far behind the curve. It's difficult to see how they can ever get caught up without a Volcker style.
Yeah. Well, unfortunately, and I'm always reluctant to say this, still looks an awful lot like the Depression, right? It looks an awful lot like the Depression. It's long, it's dragged out, it's painful, it's global, it's being met and addressed with different policies and strategies. I have many very intelligent friends that say, Dave, they have to do this because look at the pain of the Depression, the unemployment, the blah, blah, blah. So they have to do this. I usually say, well, yeah, but the guys who did this, Germany and Japan, then arguably came out of it worse, right? Because they printed money, created inflation, led to wars, and et cetera. And again, I don't want to be a fearmonger, but history shows us that not every inflation led to war, but almost every war was preceded by inflation. And again, that's that wealth redistribution. So, I always, in my Zen world of yin and yang, inflation is neither good nor bad. Deflation is neither good nor bad. They're just transfers. Right. And inflation separates wealth and deflation rebalances wealth, right? And you segregate wealth too far and then friction builds and things become unstable and you get North Africa and the Middle East and Ukraine and Venezuela and et cetera. So yeah, I think we're very close to that challenge now. I think, as I say, liftoff for the Fed is trying to address the concerns that they're scared that the externalities in economic speak are too risky relative to the benefits, the marginal gains now. The benefit may be great because you're saving the financial system with QE1, but pouring more water on an already thickened forest doesn't make much sense, right? You're probably better off storing that water for the inevitable.